Imagine waking up tomorrow and your bank account is frozen. No warning, no explanation, no access. You try the ATM, declined. You call the bank, no answer. You check the news. Your government has just announced emergency financial measures. This is not a theory. This is not a hypothetical. This already happened, multiple times, in countries that looked exactly like yours. And if you think this cannot happen in your country, that is exactly what people thought before it did. In the next 48 hours, people lost everything. Her name is Maria. She did everything right. School teacher, Buenos Aires. 11 years of saving. Every month, a portion of her salary set aside. Never missed a payment. Never took risks. Never spent recklessly. By December 2001, she had $14,000. Her retirement, her security. 11 years of discipline made liquid. On the morning of December the 2nd, she went to her bank. The doors were locked, a notice on the glass, withdrawals restricted. The government had announced something called the corralito. Bank accounts frozen, cash limited to 250 pesos per week. $7,000 gone. And she never made a mistake. Not fraud, not poor decisions, not bad luck. By government order, in 48 hours. This wasn't a mistake. This was legal. And it has happened again, in different countries, in different decades, every time following the same pattern. But here is what no one tells you. Those 48 hours are not random. The people who survived them were not lucky. The pattern repeats. And when you see it, you cannot unsee it. But most people still think this only happens in weak countries. And this is not history. This is recent. In March 2023, Silicon Valley Bank collapsed in 48 hours, the second largest bank failure in American history. Depositors above the insurance limit faced the genuine possibility their funds were gone. The Federal Reserve intervened. But the mechanism was identical to Argentina, a bank run, a frozen window, people unable to access their money while institutions decided what to do next. In February 2022, the Canadian government invoked the Emergencies Act, freezing bank accounts without a court order. Legal authority used. In 2007, British customers of Northern Rock queued around the blocks, the first bank run in the United Kingdom in 150 years. The mechanism is not unique to emerging markets. It is universal. What differs is frequency, severity, and the institutional backstop available when it activates. And this is where people make a fatal assumption. They assume distance protects them. The pattern does not care about distance. They assume distance. They assume stability. The pattern does not. Here is what actually happens, hour by hour. Greece. June 2015. Prime Minister Cyprus announced capital controls at 1 a.m., 60 euros per day. That was the limit. By 3 a.m., queues at ATMs across Athens. By dawn, machines empty. The people who moved in the first 2 hours withdrew cash. The people who waited until morning found machines that dispensed nothing. 60 euros per day for weeks. Cyprus, March 2013. Saturday morning. The bail-in announcement came when banks were already closed for the weekend. They stayed closed for nearly 2 weeks while the legal framework was finalized. Citizens with foreign accounts, unaffected. Citizens holding physical cash, unaffected. Citizens whose assets were entirely within Cypriot banks. No mechanism to respond. The window closed before most of them understood it had opened. And this is the most important thing the first 12 hours reveal. The people who preserved wealth were almost never the ones who responded fastest after the announcement. They were the ones who had already positioned their assets before the announcement happened. Speed in the moment does not save you. Position before the moment does. Hours 12 through 24. This is where the real damage begins. This is the period in which the specific design of the restriction determines who loses what. In Argentina, the corralito froze bank deposits, but did not immediately affect physical cash held outside banks. Citizens who kept cash at home, a practice that had seemed paranoid before December 2001, found their physical holdings untouched. The restriction applied to the banking system. It could not reach what was not inside it. In Cyprus, the bail-in targeted deposits above 100,000 euros. Below that threshold, protected. The design reflected political reality. Confiscating small depositors would be harder to justify publicly, so the restriction targeted concentrated institutional deposits, precisely because they were registered, documented, and visible within the banking system's records. In Iceland in 2008, capital controls prevented foreign investors from withdrawing funds. Icelandic citizens with domestic assets were largely protected. Foreign investors chasing high interest rates found their funds frozen. The restriction followed the line between domestic and foreign. Every crisis shows the same thing. The restriction hits what it can find. It finds what is registered. It finds what sits inside institutions the government controls. The assets that survive are the assets that do not fit that description. And once you see this, you start noticing it everywhere. Hours 24 through 48. The chaos has settled. The reality has not. This is the part no one expects. In Argentina, in the weeks following the corralito, a secondary economy emerged with speed that surprised observers. Barter clubs, redes de trek, eventually involved an estimated 2.5 million participants, a parallel currency system based on labor credits. The people who accumulated the most credits were those offering skills others needed: medical care, mechanical repair, food production, construction. The skill was not affected by the restriction. The compensation mechanism changed. The productive capacity did not. The office worker whose salary was deposited monthly into a frozen account had a different experience. Income inaccessible, savings inaccessible, entirely dependent on a banking system that had stopped working. Same country, same crisis, completely different outcomes, same system. The only variable was what kind of asset each person held. The historical record across every documented crisis identifies 5 categories of assets that consistently survive the 48-hour window. Now here's the part most people get wrong. At the end of this video, there is a specific question. In the comments, which of the documented cases most closely resembles your country today? Stay with this analysis to the end. The 5 categories. And this is where the pattern becomes obvious. The first asset that survives every single time is physical cash held outside the banking system. In every financial restriction examined, Argentina, Cyprus, Iceland, Greece, physical cash held outside banks was accessible when bank deposits were not. The restriction applies to the banking system. Currency held in a home, in a safe, in any physical location outside an institution is outside the restriction's reach. The limitation is equally consistent. Governments facing prolonged crises frequently move to restrict cash itself, withdrawal limits, currency reforms. Physical cash buys time in the 48-hour window. It does not provide unlimited protection beyond it. The second asset, and this is where it gets interesting: foreign currency and foreign denominated assets. In Argentina, the dollar preserved purchasing power when the peso was devalued by mandate. Argentines who held dollars outside the banking system retained the real value of those savings when peso-denominated accounts were converted at punitive rates. The mechanism: a restriction on Argentine bank accounts has no legal reach over a bank account in Uruguay. The restriction is bounded by jurisdiction. Foreign accounts may be visible. They are not necessarily reachable. Some argue that modern decentralized digital assets serve the same jurisdictional bypass function, existing outside any single government's institutional framework. The argument has structural merit. The volatility and regulatory uncertainty involved represent their own distinct risk profile. The third asset. And this one surprises people every time. Physical precious metals held outside institutional custody. The pattern repeats across every documented crisis. Metals held in registered bank accounts are subject to whatever restriction applies to the banking system. Metals held physically in private locations are outside it. In Cyprus, bank safety deposit boxes were sealed when banks closed. Citizens holding gold at home were unaffected. The asset was not inside the institution. The fourth asset is the one no government has ever successfully seized: productive skills, human capital. This is the slowest acting but most durable protection in the documented cases. In the immediate window, skills do not help. But within days and weeks, those with in-demand productive skills found alternative compensation faster than those without. The Argentina barter clubs documented this precisely: medical care, mechanical repair, food production. These skills generated value regardless of what the monetary system was doing. The fifth asset, the one with the most complete protection in the documented record: foreign real assets, property, productive land, or business interests located outside the domestic jurisdiction. A property in Portugal is not affected by a Greek capital control. A business interest in Canada is not affected by an Argentine corralito. The restriction cannot cross the border. This protection was overwhelmingly concentrated among the wealthy before each crisis, not because foreign assets are exclusive, but because the administrative complexity historically limited access. The wealthy had foreign assets. The middle class did not. The restriction hit the middle class hardest. The design of financial restrictions has evolved since 2001, and understanding that evolution is part of understanding the next window. The corralito was crude. It triggered massive social unrest. Argentina went through 5 presidents in 2 weeks. Governments studying that case drew a specific lesson. Broad restrictions that visibly harm ordinary citizens produce political instability. Targeted restrictions, affecting specific asset categories, specific depositor thresholds, are more politically manageable. Cyprus 2013 reflected that lesson. Protect deposits below 100,000 euros. Target larger ones. The social response was manageable because most ordinary Cypriots did not directly lose savings. Iceland's controls targeted foreign investors, not domestic citizens. Each case, different design, same underlying logic. The restriction reached what the government could reach. It stopped where its jurisdiction stopped. This is where most people get trapped a second time. They assume the next restriction will look like the last one. It will not. It will be more targeted, more legally precise, and harder to identify as it arrives. Maria rebuilt. It took years. Her skills were unaffected by the corralito. She continued teaching. Income resumed when the banking system partially normalized, but the $14,000, 11 years of discipline, were permanently reduced by government conversion rate, by legal order. She did not make poor decisions. She saved carefully. She did everything right. The system changed the rules while her savings were inside it. That is not bad luck. That is the design. The 48-hour window is not 48 hours of opportunity. It is the visible edge of a process that has been underway for much longer. The announcement is never the beginning. It is the end. The preparation that predates the announcement, the positioning that exists before the window opens. That is what the historical record shows actually matters. Not the sprint to the ATM at 3 a.m., not the panicked phone call on a Saturday morning. The window that matters is not the 48 hours after the announcement. It is the time before it. And unlike the 48 hours, that window is still open. The next crisis won't feel like a crisis when it starts. It will feel like a normal day, until it isn't. Look at your country. Look at your banking system. And answer this, honestly. Of the cases examined, Argentina, 2001, Cyprus, 2013, Iceland, 2008, Greece, 2015. Which one does it most closely resemble? Leave that answer in the comments. I read everyone. The responses to this question shape what this channel examines next. The corralito was announced on a Friday evening. By Monday morning, it was fully operational. The window was 48 hours. Maria found out on Saturday morning. She went to the bank on Sunday. She went again on Monday. The window was already closed, and by the time most people realized that, it always is,